All right. Hi, everybody. Thank you so much for being here with us today. I know how busy schedules are, so whether you are joining us today from work, home, or somewhere in between, we really do appreciate you taking the time to be here. My name is Kim Peterson, and I will be your moderator for this session. Joining me today is Andrew and Britti, who are both part of the wealth management team here at Wealthsimple. Today, we are talking about the 5 costly retirement mistakes, and we're doing this in sort of a let's get it right kind of a way. These are patterns that we see often, and they're usually avoidable with just a little bit of planning and some intention behind them. Before we jump in, I do have a quick few housekeeping items. Everyone right now is muted, and that's just to keep the background noise down. If you do have any questions at any point, please drop it in at any point into the Q&A box. We'll try to leave some time at the end of this to answer your questions, and if we don't get to yours, we will follow up with you afterwards. This session is being recorded, and we will send out the replay afterwards as well, and it will also permanently be housed on your CAEP website. We'll aim to keep this webinar under about 45 minutes, and that will include a little time for Q&A. All right, so let's get into it. Our agenda for today is to frame the conversation. Before we start talking about the mistakes, we need to level set on where we are today, especially for high income, high demand professionals such as all of you are. Then we'll go through the 5 common mistakes. These again are things that we see regularly. Some of them will be obvious when you hear them. Others will be more subtle as they tend to show up later. After that, we'll spend some time on what you can actually do now. The goal here is not to overwhelm you, it's to leave you with actionable items and some clarity on next steps. We'll also explain what it's like working with us for anybody who wants support or maybe just a second set of eyes on their plan. And then we'll finish with a little Q&A. So let's dive right into framing the conversation. Let me connect these 3 points for you because in actuality, they are all very related. Most physicians say things like retirement is one of their top priorities. Investment performance matters. Balancing life now with life later matters. There's no lack of awareness around this, and people definitely care about this. But when you look at the second stat, about half of Canadian physicians don't have a retirement plan. That's a gap. So, what ends up happening? Retirement decisions get shaped by 2 things: health and portfolio size. In other words, can I still do this? And do I have enough to still do that? And this, in essence, is reactive. And when decisions are made reactively, they're usually made much later than they need to be, with way more stress than is necessary. What we're really talking about today is closing that gap. If retirement, however you personally define it, is a priority, for most physicians it is, then the structure behind it has to be a priority as well. That's the foundation for the 5 mistakes we're going to walk through today. So let's dive right into those 5 mistakes. On your screen right now, they are listed. As I mentioned, some of these are technical, some are behavioral, but the good news is they are all fixable. The first one is a misaligned asset mix. This usually shows up in portfolios that don't actually reflect someone's timeline, risk tolerance, or maybe even their income structure. It might be too conservative too early or too aggressive without realizing the downsides. The second is an inefficient withdrawal order. This matters more than most people actually think. The order you draw from your accounts in retirement can have significant impact on how much tax you pay over your entire lifetime. Third is underspending. Now, this one usually surprises people, but let me tell you, it is real. Many physicians spend their careers being disciplined and conservative, and then struggle to actually use the money once they've earned it. These struggles can have surprising impacts on your lifetime tax bill. Fourth is ignoring estate and final costs. Retirement planning doesn't end at age 85, 90, 95. Final tax bills can be substantial, especially when you're working with corporations and registered accounts. And fifth is a lack of retirement vision. You can have all of the numbers right and still feel unprepared if you haven't thought through what life actually looks like when you stop practicing medicine. I'd like to now introduce you to Will and Sue Adams. We will be following Will and Sue throughout this presentation to see how their situation unfolds. They're both 65, they are retiring. They have three adult children, they own a home and a cottage, and they have about 5 million in their investment portfolios and another 2 million inside their corporation investment accounts. On paper, I think we can all agree they are in great shape. But the mistakes we're about to walk through don't just apply to people who are behind. They often show up for people who are doing very well. And in fact, the impacts of these mistakes can be exponentially higher for those who have done very well, just like Will and Sue.
I'm going to be talking about a critical but often overlooked retirement pitfall, which is having a misaligned asset mix and how it can lead to something called sequencing risk. So, what is sequencing risk? And in very simple terms, sequencing risk is the risk of having bad investment returns early in retirement, which can significantly reduce how long your money lasts, even if your average return is good. It's the order of the returns that matters the most. To illustrate this, let's take a look at an example. Investor A and B both start with the same portfolio value and have the same average annual investment return of 5% over a number of years. The difference is investor A has poor investment performance early in retirement, but then enjoys strong returns towards the end, whereas investor B's returns are in the inverse order of investor A, so good returns early, but poor later on. And you might think that since their average return is the same, their portfolios would end up roughly equal in the end. But unfortunately, the difference in their final account balances is pretty significant. Investor B ends up with over $2 million more in their account than investor A. And that's the impact of sequencing risk. So now we have a better of an understanding. Let's take a look at our case study couple, Will and Sue, and see how Wealthsimple might address a risk like this. Will and Sue started retirement with a significant portfolio of 5 million in their personal side. It's invested mostly in American stocks with a little bit in cash. They plan to take an annual amount, but they also wanted to do a renovation early in retirement and were nervous about a market downturn being around the corner. In reviewing their asset mix, we noticed that they are over-concentrated in a single market, entering retirement with a high allocation to equities. Their cash was providing inflation protection as well, or was not providing inflation protection. But also the large early withdrawal combined with the potential for a market downturn exposed them to that sequencing risk. Our approach is to find the right balance that meets our clients' needs. And in this particular situation, if they didn't make any adjustments, their portfolio would stand to take a substantial hit early in retirement, making it incredibly difficult to recover. The chart on the right illustrates the portfolio values over time, following a 30% decline in stocks at the start of their retirement. Even though their portfolio has higher performance over the full period, you still run out of money sooner. At the end of year 20, the more conservative portfolio actually has $1.14 million more. Will and Sue needed to consider a shift to a balanced asset mix that incorporates fixed income and alternatives into their portfolio. Now you might be thinking, why reduce their equity exposure? And the answer is by introducing proper diversification, it will enhance their portfolio's overall resilience, helping to protect against sequencing risk. We can't control how the markets perform, but what we can do is position the portfolio to protect against downside while still providing that upside potential. To be clear, the recommendation to move to a balanced mandate is not always the right call for folks that are coming into retirement. We looked at all the factors and felt that in this particular situation, it was the right call. By incorporating bonds and alts, or alternatives, into the portfolio, we smoothed out volatility, providing a stable and slightly higher yield than their existing cash holdings. This allowed their fixed income portion to generate more predictable income, further diversified by alternatives, lowering volatility, which would help them weather the bad markets. The key takeaway is getting your asset mix right is crucial for a successful retirement. We tend to focus so much on chasing the upside that we forget about the risk on the downside. But unfortunately, the risk cuts both ways. Instead, It's about balancing growth with stability, protecting against market downturns, and adapting your portfolio as you age to minimize things like sequencing of returns risk.
Okay, mistake number two. This is one of those things that sounds boring until you realize that it can cost you hundreds of thousands without doing anything wrong. This is not about picking that perfect stock, it's about which account you pull money from first. Most people do what feels logical. TFSA is tax free, so I'll use it first. And I don't need the corp money yet, so I'll leave it alone. Both are common and both are expensive. So I'm going to show you two quick examples with Will and Sue, and you'll see how the order can change the outcome more than people expect. So let me start by saying something that actually almost surprises everyone. Just because the TFSA is tax-free doesn't automatically mean you should spend it first. Will's instinct here was use TFSA first so I don't pay tax. Totally reasonable. But here's what's going to happen when you do that. You're basically spending your best tax shelter too early. TFSA is the only account where growth stays fully tax-free for life. And preserving this longer can materially improve flexibility later on in your life. So when we flip it and save TFSA for later, it keeps compounding tax-free. And we use other accounts earlier in a way that's more controllable from a tax perspective. And look at the difference here. Retirement plan becomes more fundable from 124% to 130 now. Net estate goes up by about 1.93 million, and your total lifetime plus estate taxes, they drop by 1.12 million. So again, the point here isn't always TFSA last. The point here is that withdrawal order is a strategy, not just preference. So simplest takeaway again, your TFSA isn't just spending money. It's often your last resort flexibility asset and your best estate tool. We want to quickly show you how the backend supports these numbers. On our planning software, you can see that preserving the TFSA funds retirement by an additional 6%. Again, this is the same household, same goals, same assumptions. The improvement is coming from sequencing, not a better market forecast. Let's project out the estate as well now. What you see here is that with Will and Sue's current plan, the gross estate sits at 10.3 million and a net estate of 7.52 million after tax. What does this mean? It means that Will and Sue are paying almost 2.7 million in estate taxes. So now let's see what happens if we delay these TFSA withdrawals. The gross estate now sits at 10.7 million with a net estate of 9.45 million. This is only 1.25 million in estate taxes now, basically less than half of the original plan. Now, here's a second instinct I see all the time with incorporated physicians. This time, Will says, I'll just keep my money in the corp. I don't need it right away. Again, totally reasonable, but it doesn't mean it's automatically optimal. A corporation is definitely a great deferral tool, no doubt about it. But deferral is not the same thing as optimization. If too much tax builds up later in your corporation, the savings can become a future problem. When we actually test it two ways, which is corp last and corp first, you can see the trade-offs clearly. So let's see. If we withdraw more aggressively from the corp earlier, which is corp first, the plan becomes way more durable. The ability to fund retirement is up by almost 17%, but it's not magic. The trade-off is that your net estate now reduces to about 470K, and the total taxes increase by almost 400,000. So again, the point here is not that corp first is always better. It's basically that leaving money in the corp by default will have a cost and a consequence. And you only see it when you model the whole system together. So the mistake here would be that I will treat my corporation as a never touch account without testing the long term impact. Now, similar to before, we quickly want to show you how this looks on our planning software. For the low cost of 472,000 on your estate, by prioritizing corporate withdrawals, Will and Sue can now actually spend approximately 18% more throughout the retirement. But again, this is a legitimate trade-off. And whether it's worth it, it really depends on your specific situation and priorities. Now, most people accidentally optimize for the wrong thing. They try to pay the least tax this year. But what you actually want is lowest tax over your lifetime, highest flexibility when life changes, and a clean outcome for your estate. And you don't get that by guessing. You get it by mapping your accounts like a system. TFSA, RSP, Corp, non-reg, all these accounts each has a job. So if you remember one thing from this section, the order you withdraw from is a decision and it's worth planning on purpose.
Now let's talk about a very common yet misunderstood retirement pitfall, which is underspending. It may seem counterintuitive, but for many, the greatest retirement risk isn't undersaving, it's oversaving to the point of compromising your lifestyle. We often see clients who were disciplined savers during their careers struggle to make that psychological shift into the decumulation phase. It's naturally difficult to watch your portfolio balance decrease. This is where an advisor provides significant value through behavioral coaching. We act as an objective third party to help you navigate the emotional biases associated with spending and ensure you maintain the discipline to actually follow your financial plan. Consider Will and Sue. Their original plan called for a $300,000 annual spend. However, like many retirees, they became overly cautious and reduced their spending to $200,000, deferring major goals like their home renovations. And because they lived long, healthy lives to age 95, that caution resulting in an unintentional $8.21 million estate and a substantial terminal tax bill. In their case, excessive prudence meant that they left behind millions that could have been used to enhance their own quality of life. While legacy is a valid goal, it's important to remember that these assets are a result of your hard work. Most heirs would prefer to see their parents enjoying their success and perhaps sharing some of that wealth with the next generation today, rather than simply receiving a larger check down the road. We worked with Will and Sue to pivot their strategy, resulting in a lifestyle they could actually enjoy and a more tax-efficient transition of their wealth. Our role was to rigorously test their financial assumptions. We quantified a higher spending limit using evidence-based planning. By updating their financial plan to reflect a modern asset mix and conducting extensive stress tests, simulating a 30% market correction and an ongoing underperforming portfolio, we demonstrated the resilience of their capital. The analysis confirmed that Will and Sue could safely increase their cash flow by $10,000 per month, or $120,000 annually, for the duration of their retirement. This empowered them to move forward with their renovation goals and adopt the lifestyle their years of hard work had earned. The strategic advantage of this increased spending was the effect on their terminal estate. By reducing the surplus that would have otherwise been heavily taxed at death, they streamlined their eventual tax liability. Ultimately, they achieved a more balanced outcome, maximizing their own utility today while providing a more efficient, less taxed inheritance for their heirs. Same as before, quickly switching back over to our planning software, I want to illustrate for you how this 31% buffer that you see here insulates a client's financial plan. So if we were to create a what-if scenario that simulates a 30% market downturn in early retirement, coupled with an ongoing reduction of investment returns of 1%, we can see that Will and Sue's retirement funded status remains 100%. This is why it's important to slightly overfund retirement, as you need to be prepared for a worst case scenario. Now, to be clear, successful decumulation is not about indiscriminate spending. It is about rigorous financial integration. Without a comprehensive strategy, retirement spending often becomes reactive rather than purposeful. A structured financial plan serves as the necessary framework for these decisions. This process quantifies your required cash flow, identifies the most tax efficient withdrawal order across your accounts, and ensures the longevity of your capital. We work with you to develop this roadmap and execute stress tests to verify its resilience against market volatility or inflation. At Wealthsimple, our objective is to provide the data necessary for you to maximize your retirement lifestyle while optimizing the tax efficiency of your eventual estate.
All right. Mistake number 4. And this is one that nobody wants to talk about. Why? Because it's uncomfortable. This is also the one that can actually take the biggest bite from your portfolio. This section is about the final bill. What happens when you pass away and what your family actually deals with. The headline here is simple. If you are not planning for final taxes, you're not leaving behind a legacy. You're leaving a liability. Quick recap of Will and Sue's situation because this matters. Up to now, we've already improved the plan in a few key ways. Number 1, we align long-term investments to match Will and Sue's spending. Number 2, we set a drawdown order, RSP and non-reg first, TFSA last. Number 3, we withdrew more aggressively from the corp. And number 4, we increased spending by 10% and also included that 100,000 in renovation as well. So on paper, it looks great. Retirement is funded. The legacy numbers also look healthy. But here's the trap. Now, in Will and Sue's case, we were able to strategically plan for their estate. But a great retirement plan can still produce a brutal estate outcome if the final taxes aren't handled intentionally. Will and Sue's plan was basically that the cottage will go to the kids and everything else is split equally. And in Will and Sue's case, it doesn't matter, not because estate planning doesn't matter, but because we've already solved for it. Due to the changes we made in the drawdown strategy, we can say that this actually works. Not because their initial estate plan was sufficient, but because almost all of their taxable assets now have been accounted for in their drawdown. We focused on taxable accounts such as RSP and corporation, and now the cottage is the only appreciable asset they have left. Instead of dealing with the stresses of transferring ownership to their kids on a strict timeline, it does not matter when the land transfer happens now. As you can see on the slide, prior to the changes we made in the financial plan, their overall tax burden at death was over $2.5 million. In this case, transferring their cottage and paying capital gains at that time would have been a major expense. But since the cottage is now the only taxable asset in their estate, there are no concerns about the timing of disposition. It can be at death or it could be earlier if it's more convenient or aligned to their priorities. So what's the wake-up call here? This is what families don't see coming. There are 2 costs when you pass away, and most people only obsess over the smaller one. Probate is annoying, yes, but the real monster is the tax bill. And you can literally see here it on the screen. Current plan versus proposed plan. The total cost drops massively. So again, the message here is not avoid probate at all costs. The message here is that don't get distracted by the fee and ignore the tax. Because your heirs don't remember what you meant to do, but they will remember what they had to pay. Now, while this doesn't apply to Will and Sue, most estate problems aren't really investment problems. They're paperwork and coordination problems. Take a screenshot here and ask yourself, if your executor had to figure this out tomorrow, would they know exactly what happens and what it costs? If your answer is kind of or maybe, then we've found the gap.
For the 5th and final mistake, I want to talk to you about a lack of retirement vision. And this sits outside of the numbers of your financial plan and addresses some key concepts that many retirees never consider. We've spent the last 27 minutes talking about math, asset mix, withdrawal sequencing, and estate costs. But there's one mistake that doesn't show up in that spreadsheet. Our retirement can look perfect on paper and still fail in real life. Plans will model income, tax, and portfolio growth, but what they don't model very well is what actually changes when you stop practicing. Your role changes, your routine changes, the pace changes, the daily contact with colleagues changes. And when purpose, structure, and connection change, we see real effects: higher rates of anxiety, isolation, unhealthy coping. Even people going back to work, not because they need the money, but because they weren't ready for the change. So when we talk about retirement vision, it's not a soft conversation. Money is the tool, but the life comes first. And if we don't design the life, the numbers don't mean as much. Before we touch the numbers, these are the kind of questions you should start with. When the shifts stop, what gives your weeks shape? What replaces the pace? Especially in something like emergency medicine where the intensity is real. Then we have identity. What part of being a physician do you actually want to keep? Is it teaching, mentoring, leadership, advocacy? Retirement doesn't mean walking away from contribution, but it does mean being intentional about what stays. Connection is another big one. Who are you seeing regularly, not just at the occasional dinner? What communities are you a part of? Those rhythms protect mental and emotional health in ways that money alone just doesn't. And then we have health itself. What are you doing now that supports your physical and cognitive health long term? Not just so you live longer, but so those years are strong. Finally, we have meaning. What makes a good year feel like a good year to you? If we can't answer that, it's very hard to build a drawdown strategy that actually supports it. And these conversations don't replace the math. Instead, what they do is inform the math. And when they're done properly, the financial plan stops being about hitting a number and starts being about funding a life you've actually thought through.
So, we want to leave you with some actionable items. Ask yourself all these important questions. And again, take a screenshot of this. What we see with clients is that most plans fail not because of complexity, they're failing because no one asked all these questions early enough. If you don't know the answer to any one of these, then that's your starting point.
So everything we've talked about today, your asset mix, your withdrawal order, spending, estate taxes, vision, none of this works in isolation. You need coordination. And this is where working with a team matters most. You need somebody who can model those scenarios, do the stress tests for you, sequence the withdrawals and show you, and then adjust the plan as your life evolves. Because retirement, it's not a spreadsheet event. In actuality, it's a transition, and that transition can be 25, 30, 35, and beyond years. Our role is to make sure that your financial structure supports the life you actually want in retirement. At Wealthsimple, our personalized wealth management service connects you with a dedicated advisor to build and maintain that tailored strategy across retirement, tax, estate, and investment planning. We start every relationship with a holistic plan because it's important we know where you are and where you want to go. How you intend to use your money informs how we allocate your investments across different assets. Although the plan is important, life isn't a perfect plan, nor is it a document. So we are there for all of the important events, providing you with ongoing proactive advice during your biggest decisions. Now we want to take a look at a client situation at Wealthsimple and walk you through exactly what it looks like when you are a client of Wealthsimple Wealth Management. We're going to be looking at Pedro's account. In your first few meetings with us, we will take the time to get to know you, what matters most to you, how you think about money, etc. When you're ready, we make the transition seamless. We handle everything, setting up your accounts, notifying your institution, watching your transfers closely. We become your in-house tech. While your assets are in motion, we're already building the foundation of our relationship. your financial plan. We know you don't want to go it alone. You want to have an advisor you can call on before making a big decision, somebody who shares insights even before you ask, somebody who understands your goals and isn't afraid to challenge your thinking when it really counts. Our clients tend to want more than quarterly check-ins or a one-size-fits-all plan. They want that real relationship. And they found it here at Wealthsimple. We have a modern experience for people who want the best of both worlds. Speed of our existing platform paired with the wisdom of a dedicated advisor. Because great advice shouldn't be transactional or cold. Great advice, it's human, and it's definitely personal. Speaking of humans, this is an example of our team here at Wealthsimple Wealth Management. Our team is full of human experts. As you'll see on the screen, we have CPAs with accounting and tax expertise, CIMs and CFAs with portfolio management expertise, CFPs, financial planning experts, TEPs who are estate and trust experts, and CLUs, insurance expertise. We have the experts to help you through life's transitions.